To be able to make money in trading, I think it's so important to understand how options are priced so it can help you make better and informed decisions. That's why in this video I wanted to cover how options are priced, what is extrinsic value, what is intrinsic value for example, and how it can help you make more informed decisions in trading. And make sure you stick until the end of the video because I'll be giving a mind map that I've created that basically summarizes everything we're going to cover in this video. And if at any point you find this video helpful and you learn something, please consider subscribing to my channel and liking this video. That's really the best support you can give me and I'd really appreciate it. So when you look at an option chain and you see all of the strikes for a particular stock and you see all of the calls and puts associated with that strike and you see all of the prices, it's very important to understand how those options are actually priced. And the very first thing to understand when you see an option that is, for example, costing $1 to buy, the first thing to understand is that an option controls 100 shares of the stock or ETF that you're looking at, meaning that when you see that the premium is $1, you actually have to multiply $1 by 100 because it's 100 shares to understand what is the real cost of the option if you were willing to buy it. Meaning that if an option is costing $1, then the real cost of it is $100. But the question is, how is that $1 option priced? What are the components behind this? There are two main components that make the price of an option. There is what we call the intrinsic value and there is also the extrinsic value. But first of all, let's talk about what is the intrinsic value. An option has intrinsic value only if it's in the money. And small reminder maybe for those who don't know what is in the money, out the money. Well, an option is in the money, for example for a call option, if the stock price is above the strike price. And for a put option is in the money if the stock price is below the strike price. And to know how much intrinsic value an option has, you need to subtract the strike price from the current stock price. So let's take an example so you can see clearly what I mean. Let's look at Tesla and let's take the closest expiration that is available, so it's October 23rd. Let's focus for example on the 410 call option. Well, you see that call option is in the money. The last price for Tesla is $421 per share and this call option has a strike of 410, meaning that the call option is right now in the money because the stock price is above the strike price. And to calculate the intrinsic value for that call option, well, as I said, you need to subtract the strike price from the stock price, meaning you do 421 minus 410 and 410 being the strike price. And you can see that we have $11 that is left, and that $11 is the amount of intrinsic value that the option has. But you probably have noticed something very weird right now. I said that an option only has intrinsic value when it's in the money, but when you look at the premium for the 410 call option, you see that it's around $22. It's a premium of $22 and we have around $11 of intrinsic value. So where does the rest come from? And that leads us to talk about extrinsic value. And all options have extrinsic value, regardless if they are in the money or at the money. And to be more precise, out of the money options only have extrinsic value because we know that an option has intrinsic value only if it's in the money. So for all of the options that are out of the money, there is only extrinsic value that make the premium. And something that you might be wondering is why an option that is out of the money would have any value. Well, before talking about what is exactly the extrinsic value, I want you to put yourself in the shoes of someone who would like to buy an option that is currently out of the money. If you buy an option that is currently out of the money, what are you hoping for? You're hoping for the option that you're buying right now to go in the money so you can make a profit if, for example, you exercise your shares or if you just sell back your options. So when people are buying options, they obviously hope for something to happen. They obviously hope that the stock price is going to go in their direction and they're going to make a profit. Meaning that even if the options are out of the money, there's still value in them because people are still willing to buy them because they're hoping for the price to go in their direction. So there is still value in those options, and this value is what we call the extrinsic value because there is still a potential for those options to go in the money. And the extrinsic value is composed of mainly two things: the time to expiration and the actual volatility for that option. So let's focus on the time to expiration for the moment. To make you understand why there is value in the time that there is to expiration, let's picture you in the position of an options buyer. And me, I offer you two alternatives: whether you're going to buy an option that is going to expire tomorrow, or you're going going to buy an option that is going to expire in 1 year. And obviously, as an option buyer, what you're hoping for is that the option that you're buying goes further in the money so you can make a profit. And looking at the first alternative that I'm offering you, if you buy an option that is expiring tomorrow, you really have little chance of seeing that option going in your direction and so make a profit, compared to the option that expires in a year, where you have a lot more probabilities of seeing a profit on that option that you're buying if it expires in a year. Because there is so much time and so many things could happen, you really have a lot more probabilities to make a profit on the option that is expiring in 1 year compared to the one that is expiring in 1 day. That's why the more time there is to expiration, the more value there is in the option, because there are more probabilities of seeing that option going in the money. And for the option buyers, that means profit. So we covered the first factor, which is the time to expiration. And now let's cover the other factor, which is the volatility. Well, think about the volatility as the supply and demand. I'm sure you remember those economic classes that you probably have taken where we talk about supply and demand. Well, that's exactly this. If a lot of people are willing to buy an option, what is going to happen to the price of that option? It's going to increase because a lot of people are willing to buy it. So the incentive for option sellers is to price their options at a higher price because a lot of people are going to buy it anyway. And on the contrary, if there is no one willing to buy an option, well, option sellers are going to have to decrease their prices so as to find liquidity, so as to find option buyers. And you can see that in everything, not just options. For example, sports cards, figurines, everything that is now becoming part of a collection has a lot more value than there was in the past, because now there's a lot less supply and there's a lot more demand. So the price for example, sports cards or anything that has value right now is super expensive because there's a lot of demand for it. And that's exactly the same for options. If there is a lot of demand for a particular option, you can be sure that the price for that option is going to go through the roof. And you can really see this effect of supply and demand, especially during earning events. When a company is releasing their earnings, there are a lot of people ready to buy a lot of options because they think that the price is going to go in a certain way. And what happens to the price when a lot of people are willing to buy options? It increases. That's why option prices increase so much prior to an earning event up to the moment where the earning is released, because people are hoping for the price to go in that direction. And that's why the option prices decrease so quickly just after the event, because no one is willing to buy options anymore. So what happens to the price? It decreases. And that's how the extrinsic value is being calculated. It's really only about the time to expiration and the actual demand for the option. And I know it's a lot of information at once. That's why I've created a mind map where you can basically see what we just talked about. And I've put some notes every time, for example, for extrinsic value, intrinsic value, option premium, with more information so you can see by yourself and you can remember more easily what we just talked about during this video. And to access this mind map, just go in the description of the video and you'll find a link where you'll be able to access this mind map. And that's when you understand how options are priced that you can start understanding how to take advantage of them. And understanding how options are priced is very important because it also explains why you can, for example, be right in the direction of the option you bought and still show a loss in your P&L. And that's because of the demand for that particular option that just drops, and so the premiums, and that's why you, for example, show a loss even though you were right in the direction of the stock. Because there is not only the stock that matters in the option pricing, there is also the volatility and there is also the time to expiration. And that's why you can start taking advantage of options when you start understanding how options are priced, because you can start taking advantage of the time to expiration by selling options, or you can start taking advantage of the actual supply and demand by selling options when the implied volatility is high. And I've already made video on that subject, so make sure you go check my other videos, because I've already talked about, for example, strategies to use during high implied volatility environments. I hope you enjoyed this video, and if you've watched until the end, thank you so much, I really appreciate it. I wish you all the best and I'll see you in the next video.